Today's conversation is going to be around whether or not you should consider a Roth conversion. And those of you that registered for this, I've had a conversation with many of you already around Roth conversions, whether or not you should consider it, what does it look like? So I appreciate you joining in today to learn more about the strategies and why you would consider a Roth conversion. As I go through the presentation, if you have questions, just put it in the chat feature, and then I'm going to address them during that particular slide. So I'm going to try and keep everybody muted for now so I can get through the presentation, but feel free to put in the chat, which is at the bottom of your screen there, in the chat, put your question, and then I'll address it, okay? For today, we're going to talk about the difference between Roth and traditional. We're going to talk about how to actually do the Roth conversion, the advantages of doing a Roth conversion, and like anything, there's a trade-off. There are disadvantages also of doing a Roth conversion. I'm going to walk you through some real-world case studies. So think about when you've sat down, we've gone through tax planning and all these other things, and I bring this stuff up. I'm going to show you actual cases, okay? And then I've got a little something at the end that I think you guys are going to find very intriguing as we talk about not only conversions, but your estate and what happens with your heirs if you were to consider a Roth conversion. So that'll be our bonus material at the end, okay? What is a Roth conversion? We've all heard about it. It's all over the internet. You've probably read it in the newspapers. It gets a lot of attention and frankly, a lot of it's noise. But we want to think about it from your perspective, and that is you have a traditional IRA, and that is pre-tax. So picture from your employer, you've been contributing to this account over the years, you're retired. Now I have this traditional pre-tax IRA, or maybe you have a pre-tax 403B, a pre-tax Ohio Deferred Comp 457. All of those pre-tax accounts, if they were in a traditional IRA, you can convert that to a Roth. Okay, so think of any pre-tax money eventually can be converted. Now, the big thing here is you can't convert if it's sitting in a 403B or a 457. So it actually needs to be in the IRA to start converting. If you do the conversion, it's no different than pulling it out as income. So you're going to pay ordinary income tax on that. And you may say, Todd, why would I ever do that? That sounds crazy. Pay tax on it. You're going to pay tax regardless, and so are your heirs, whoever the beneficiaries of your account are. So I'll talk to you about strategy here in a minute, but yes, any conversion, you must pay ordinary income tax, okay? But that amount that gets converted ends up growing tax deferred and tax free when you take it out. And that'll be really important. I'll show you here in a minute. Now, with a Roth contribution, there's a lot of confusion around this. So think of Roth contributions. I'm working, I want to contribute $8,000 to my Roth IRA because I'm working. Great, you can do that. That has a limit, okay? And that's what this third bullet point is telling you. If you make too much income, you can't do a contribution. Okay, Todd, I make too much income, I'm retired, I can't do this conversion. Wrong, you can. Contribution and then conversion, two totally separate things. The amount you convert just bumps your tax bracket and your Med B bracket. Okay, so you could convert 100,000, you could convert 1,000,000. There's no limitation based on income or contribution amount. Okay, so remember, they're two different things, easy to get them confused because one's a Roth contribution, the other one is a Roth conversion. Okay, so let's talk about the difference between the two. You're working, you put money into a traditional IRA, most of those contributions are tax deductible. So think of this if you're retired. Hey, when I was working at OSU or my employer, wherever I was contributing to these accounts. I was contributing to my 403B, my 457. that all went in pre-tax, okay? That's a tax deductible contribution. It lowered your income. So just like a traditional IRA, pre-tax contributions in a Roth IRA, there's no deduction for the contribution. You put in that $8,000 this year, I don't get to deduct that on my taxes. Do both of them grow tax deferred? Yes. So until we take the money out, it's growing tax deferred. So, hey, my account just went from 100 to 200. Do I pay tax on it that year? No. Tax-free withdrawals, not in a traditional IRA. And everybody on this call pretty much has a traditional IRA with me. So when you take money out, as you know, whether it's a required minimum distribution, whether it's for income purposes, it does not matter. You pay tax on it at your ordinary income tax level. So whatever your marginal rate is what you pay. Now, if I'm taking money out of my Roth IRA, do I pay tax on that? No. Why? Well, remember, I didn't get to deduct it, so it wasn't pre-tax, it's after-tax money, and then it grew tax deferred, and now I want to take it out, it's all tax-free, okay? So this is the difference between traditional and Roth. Now, if a couple of you on here are actively working, Todd, I want to contribute to my traditional IRA, can I deduct it? Potentially, depending on how much you make, which it's in there. Or can I contribute to my Roth? Potentially, right? So I just talked about conversion versus contribution. There are income limitations to contributing to these things, okay? So we have to keep that in mind. Our distributions required at age 73. So some of you on here already know about this. You're in RMDs right now. Todd, I don't want all this money. I'm sorry. Here you go. Uncle Sam wants their taxes. So under the pre-tax traditional IRA, we know that those accounts are required to take that RMD. In the Roth, are they required? No. So are you telling me I can have this account and never take money out of it? Yes. It is not required to take anything out of your Roth IRA. Okay. So those are the differences. Now, let's talk about actually how you do this from a strategy standpoint. Okay, so let's say you have $10,000 in cash sitting in your traditional IRA and you convert that over to your Roth. Great, not a problem. So you decided on the amount, you completed the conversion. Now you just need to let your tax person know and they're going to complete 8606 for you. Not a problem. Very simple. But now let's assume you own a mutual fund, an ETF, an individual company inside your traditional IRA. Well, Todd, I want to convert XYZ company. Okay, let's convert 100 shares at $100 and get that same 10 grand in there. No different. I didn't have to sell the shares of my mutual fund, ETF, or stock. I just move over the stock and based on that daily value determines about what the conversion is, right? It may be a little more, a little less than that 10. One of the opportunities, and I've been talking to people a lot about this spring as I'm meeting with people, is if we're in conversion mode, so we've already agreed that it makes sense to do a conversion, what we think about doing is taking that same XYZ company and finding time periods like we've been experiencing over the last few weeks, month. The war with Iran, what's been happening with the market? Well, the market has been falling, right? So, hey, we've already decided we want to convert 10 grand. Why don't we today convert that same XYZ? The price is lower because the market's going through a correction, so we can convert more shares at a lower price, same dollar amount. But then what happens when it recovers? Well, all of that difference also becomes tax-free. So there's a real advantage to doing this, okay? Let me give you an example of this. I just did one a couple days ago, okay? Had the person sign the DocuSign. He has a traditional IRA. Inside that traditional IRA, he owns Microsoft. And Microsoft this calendar year is down 20%. And I said to him, hey, why don't we convert this? And then when it comes back, if it's a $20,000 conversion and it comes back that 20%, well, that $4,000 doesn't show up on his tax return anyway. So just it coming back to even, that 4,000 sitting in his tax-free account. And so sometimes it's wise not only to think about the conversion dollar amount, but it's also an opportunity. Hey, the markets are down right now. Can we convert this over? And then when it comes back to even, then all of that's also tax free. So these are some of the strategies that I want you guys to think about. And then we can talk about as we meet and have conversations. What are the advantages? Well, we already know the one that stands out to all of us. Anytime we hear tax free, we all get excited, right? So we've got tax free growth. It's tax deferred, right? So we're not paying anything along the way. And then when it comes out as income, we're not paying any tax on. So that's awesome. Lower current tax rate. So picture you're in a situation. I have a couple people this past year that this happened to. Hey, Todd, I'm going to quit my job. I'm going to start a business, or I'm going to go ahead and retire, but I don't want to take any money out of my accounts. Social Security hasn't kicked in yet. Okay, great. We're in this temporary lower tax rate before Social Security kicks in, before our RMDs kick in. So what do? Well, let's get what we can out. My meeting this morning at 10 a.m. Couple in Cleveland. We've been doing this every year. Hey, let's fill up that bucket until your Social Security kicks in. And so last year we did one of these for $34,000 for them. Okay. Because they're in a 12% bracket right now. And I know here in a couple years when Social Security kicks in for the two of them, they're not going to be in the 12% bracket. So it's taking advantage of that lower current tax rate for some of you. Now, not everybody is in that situation. I get that. So we're going to talk about that particular situation here in a second. You can avoid or reduce your RMDs. So what do I mean by that? What's the advantage to the Roth when it comes to RMDs? First of all, we don't have RMDs with a Roth IRA. There is no such thing, okay? The other thing is we can reduce those future RMDs. So, hey, Todd, I've been taken out doing these conversions. I still have this pre-tax account. Yep, sure. Well, that pre-tax account's only a 500,000 now instead of 2 million, which RMDs are always based on that 12/31 prior year balance, right? So now you've just reduced your RMDs. You didn't get everything out of the pre-tax, but you've at least reduced that required minimum distribution. And what do we know? Tax diversification's always great, but I always think of this as more tax certainty. We know what we're paying today versus what the tax rates could be in the future, or to our heirs, what they may end up paying. So that's the advantage of a Roth conversion. There are just as many disadvantages, so we have to be careful. And this is why I say Roth conversions are noisy. What do I mean by noisy? Well, noisy is, hey, everybody should do a Roth conversion. No, 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 no. Not everybody should do a Roth conversion. Okay. There's just as many people that I recommend Roth conversions to that I tell, no, you're not doing a Roth conversion, and here's why. Okay. So there are disadvantages also that really are just about as many as the advantages. So immediate tax liability. Wow, I just did $100,000 conversion. I'm in the 22% marginal bracket. Where am I coming up with $22,000 to pay for the tax on this conversion? Huge, huge issue, right? Todd, when we did this conversion, it just pushed me into a higher tax bracket. I went from 12 to 22, or I went from 22 to 24. Yep, that's right. So remember, it's all income when we do the conversion. Medicare premium hikes. Many of you on this call are Medicare eligible, right? So you know, hey, I'm paying a lot of money right now for my Medicare premium. Yep. Can that go up? Absolutely. Why? Because it's all income. My income determines my Med B bracket. But think about this. If you're already in the top Med B bracket anyway, it's not going up, right? I'm going to show you an example of this here in a minute. The 5-year rule. So converted funds must remain in the Roth for at least 5 years. Okay. So just keep this in mind, is that when we convert, we keep them in there. Okay. Social Security taxation. Yes. Maybe you're 0 or 50 or 85% of your Social Security taxable. Almost every single one of my clients are 85%, the max anyway. So I wouldn't think of this disadvantage as impacting you guys. Okay. So let's look at an actual case study. This is going to look very familiar to all of you on this call. If you're clients, you know this is part of our tax planning process. So this screen here looks very familiar. So this particular person, we can see 1 year on the left and the following year on the right. What did I recommend? Where the circle is, that 40,000, what does that say? Roth conversion. Wow, a $40,000 Roth conversion that year. Yep. And when we did that Roth conversion, what happened? Well, you could see here on the left, here was their prior year income and then their post-conversion income. They're over age 65, so they got that new $6,000 per person, that senior deduction. So you see that 12 plus their standard deduction. Okay. So those two, along with the conversion, their income was still very low, down around 92,000. Well, that's great for them. Look what happened to their total tax bill on the right. Went from 23,000 down to about 12. They dropped a marginal bracket from 22 to 12. That looked great. So when we saw this for the client, we thought, wow, they're in the 12% bracket. We should do a conversion. So that was the second part of the conversation. We recognized where the client was from a tax standpoint, and we said to them, how do you feel about doing a conversion to stay in that 12% bucket? No different than my 10 o'clock appointment this morning where we did 34,000 for the client out of Cleveland last year. And I told him, he just uploaded his taxes. I said, our next meeting will be on taxes. I'll determine your dollar amount for this year. Okay. And this is a great situation for this client because they paid 12% marginal tax on that $40,000. So let's call it about 5, 6 grand. Okay. Not a problem. And in some cases, I had this maybe about 2 weeks ago now. We're actually going to, couple is retired, spouse has been retired for about a year. Now the husband's retiring this year. And what we're going to do is they don't need any income and the Social Security hasn't kicked in. So her pension's enough to cover their monthly income or need. And so what we're doing is we're going to start these conversions right out of the gate. Okay. And so you have to think about just the time period that you're in. And I'll walk you through all this when we meet. Does this make sense for you? And what's the outcome, good or bad? So you know if you're in a situation where you should be doing this. And a lot of times I've already talked to all of you about this, but I need you to understand more about what's happening. Okay, so case study number one, we also know what? We saw the advantage and disadvantage. One of the disadvantages, it's all income. What do we know about Med B? All of you that come in here, Todd, I don't want to cross into that IRMA bracket, or oh my gosh, I can't believe I'm almost at the top. Yep, it impacts IRMA. So in this particular case, we could see we did the conversion, kept the person still in that Med B tier 1, okay? And this is something that when we do our analysis for all of you, essentially we're showing you, here's your new tax bracket, here's your new Med B premium, so that we can calculate what that advantage is. Let's talk about the lower wage. I brought this up already. Hey, this particular person is the one I mentioned with the Microsoft. So, hey, I'm going to start a business, Todd. I'm going to lose some income this year. Okay, great. So here's the Roth conversion, 35 grand. And you can see the lost income. So again, it's just taking time periods into consideration. I have a client that lives down in Florida, did the exact same thing. Great, you're in a 0% tax bracket. We're going to convert these things all day long, right? And for him in particular, I think we were doing $100,000 a year conversions while he was starting his business. In the future, we know his business will grow. He'll be back in a normal tax bracket. So let's get as much done as we can right now. And you can see in this particular case with that $35,000 conversion, they still went from the 24 down to the 12% bracket, from paying 42 down to 6,800. So that was a great situation. Okay. Now, case study 3. This is going to impact a lot of you on this call. On the left side here is this year's tax rate schedule. So when we've gotten together and I talk about the marginal bracket that you're in, that's what this chart is showing you. So just find yourself on here. Hey, I'm single or I'm married filing jointly. Here's about our income. Look to the right. That's your marginal tax rate. Okay. So you think, oh, I'm in the 24% bracket. I can go up to 403,000, whatever the number is that you've kind of laid your eyes on. That's what I want you to think about as I'm going through this example. So client comes into us, they have 225,000 of income. They're married filing jointly. Their R&D at age 78, okay, so this is an actual client situation, is $91,000. So that 91 is pushing them up to 316,000. They're now in the 24% marginal bracket, and their IRMA is about 300 a month. Total tax liability about 52 grand. Okay. So I'm having a conversation with this client maybe a month and a half ago during a meeting. And I said to him, hey, I really want to think about whether or not you should be doing conversions. Why would I do that? I'm already in a high tax bracket. Yep, you're right. But what I worry about is what we call the widow's penalty. What does that mean? Well, let's take this joint client and assume that one person passed away. What happens? We have one person that's getting about 200,000 of income. Now their tax status is single, still required to take the RMD because remember, it's a pre-tax account. And now my total income just by myself is 291. What just happened to my marginal bracket? So I went down in income, but I went up in marginal bracket, right? And you see that here on the left. So I went from 316,000. Yep, you can see that, right? Right here. Let's just look at joint 316, 24%. Now I'm 291 and I'm single. Now I'm in at 35%. You see that? Okay. So this is the big fear that I have for clients is we have sort of a ticking time bomb that's getting ready to happen and we don't even know it yet. Because here's what that widow experienced, an 11% increase in taxes. And look at that IRMA bracket, just went from 300 a month to 730. My total tax liability by myself is 65 grand. Okay. So think of the difference here. We can see Medicare cost me an extra 3,500. The tax cost about 12 grand, right? And this person, you can see, I'm giving you an example here. This is a client situation. Let's say 2 million in pre-tax, 78, and their RMD factors. So this gives you a sense of this is really what's happening out there. Okay. So just keep in mind, these are the things that I worry about and think about as we're giving you advice in whether or not you should do these. Okay. Now, before I go on to the next slide, I'm going to put up an assessment that I would like you guys to just answer real quick for our next webinar coming up. What topic would you like to hear about? Do you want to hear about how the tax bill last year has an impact on your particular situation? Do you want to hear from a travel expert that does international travel? Do you want to hear about estate planning, tips and tricks so that you can avoid having a mess left for your heirs, whether it's tax or just dealing with the estate? So I'm going to give it another 30 seconds here. If you could answer that to give us a sense. Okay, people like estate planning. So tax and estate. The good news is you like the other things too, which is great. So maybe we'll just do all three, but I suspect estate will be next, and that'll be a good one. So I'm going to give you a little preview into estate. Okay, so this is that bonus material. Okay, so let's go on to the next slide. You can see here the results. Okay, now this is really important. I know a couple of you on this call have heard me talk about this. So I hope that this doesn't feel redundant, but hearing it more, I think, helps because it's complicated. And this goes to tax and estate. Okay, so we're talking about Roth conversions. What do we know about conversions? Pay the income tax today to have tax-free income in the future. And what do we know about that tax-free income? That tax-free income is also to our heirs. So when they inherit this Roth IRA, they also don't pay tax on it. Okay? So here's a client situation. What do? We have a couple kids, and in this particular case, we have a donor advised fund or a charity that you want to name. Okay. And we say, okay, kid number one lives in a different state, has a higher tax bracket than kid number two. And then what do we know about the charity? The charities don't pay tax as long as they're a qualified 501(c)(3). Okay, great, no problem. So we're going to take all of our assets and we're just going to divide it equally. It's just easier, right? I have three kids. And so I think of this. I'm just going to give them each 1/3. Okay, not really think too much about it. This is extremely normal. This is what I see every single day. This is what even estate planning attorneys do because it's just not as complicated for them. Yep, let's just put 1/3 in your trust and move on to the next person. Okay. But I say, wait a second, stop the brakes. Okay, stop the car here. Put the brakes on. Think about asset location, where your assets are. So what do we know about the top part of this circle on the left? Your non-qualified assets, homes, checking, savings, bonds, joint account. What are these? These are all after tax, all of them. You've already paid tax on them. What happens when you pass away to non-qualified accounts? It gets a full step up in basis. No taxes owed. That's how the tax code's been for a very long time with non-qualified assets. So why would we give our charities or our donor advised fund non-qualified assets? We want to give them as much of the pre-tax stuff as we possibly can because they're not going to pay any tax on the pre-tax. So all that non-qualified needs to stay in kid one and two. Okay. Now, you see, I put the Roth IRA kind of in between non-qualified and qualified. Why? Roth IRAs are considered a qualified asset because they're retirement. However, they are tax-free. So again, kid number one and kid number two should be getting non-qualified and Roth assets first. And then if there's anything left that doesn't divide this up by 1/3, then they get some of the traditional IRA and then the rest goes to charity. Okay. So think about this in context of your particular situation. Okay. So I have two kids, Todd. Great. One lives out of state, married, has kids. Another one lives here, single. How do I think about them? Okay. Let's think about what their tax brackets are and how much they should receive. Okay, 50-50. We're not going to give anything to charity. Great, not a problem. So now what I do is I think, okay, well, how much is child number one going to get and child number two? And you say, well, it's 50-50. They're going to get the same. And I said, no, 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 no. Remember, they live in different states and they have different income tax brackets. So child number one's got a 12% bracket, child number two's got a 22% bracket, and oh, by the way, lives in a state that has a much higher state tax than Ohio does. Well, you just thought you gave the kids 50-50, and then what happens? One ends up with less. Okay. So asset location doesn't really get talked about very often, but I think it's a critical piece in your overall estate plan. Which assets go to which child, which charity makes a big difference in the total wealth that is passed to your family or your charities. It makes a big difference. And so when I think about this, I really do want you to have these conversations with me when I'm bringing them up during our estate planning session or our tax session. We'll talk about these in particular for your case. I want you to understand this stuff ahead of time so that we can have very good discussions around what you should do, not what everybody else in the world's doing, not what your friends are doing. It's what you should do. What's your situation and what do you want to accomplish? What are you trying to pass to the kids, to the grandkids, to charities, whatever it is you're trying to do? We need to map that out for you in a tailored way. Okay. So that's all I have for you today. I'll be happy to take any questions that you guys have. I hope that you got enough value out of today's presentation.